Oh man, welcome to a Jerome Powell Congress hearing live stream. We're going to cover off exactly what Jerome Powell talks about. As you guys know, Bitcoin, as we speak right now, is breaking through 29,000, sitting at 29,200. Will this Congress hearing allow us to move towards 30k and onwards? Which, remember, is that cup and handle pattern? Or is it going to be a rug pull by Jerome Powell which pushes us down to the downside? Remember, this is a Congress hearing. He does this twice a year and he gives us a clue about the economy, maybe some clues around his rate hiking strategy. Of course, we had the pause previously. So loads of clues which the markets will be looking at. TradFi will be looking at it. And of course, we know TradFi got a big part to do with Bitcoin nowadays in the new status quo as well. But Bitcoin looking extremely bullish. If you've not watched my TA video from earlier today, make sure you get caught up on that later on as well. Lots of key price targets going on. Of course, from a horizontal level, we've just broken through 1, 2, and now 3 clean horizontal levels. And then we want to look towards this big wedge, right? This big wedge which is forming right now. We want to make sure this breaks out nicely. Make sure you let me know if you can hear me okay, guys. I do have the fan on, which could be causing some problems, but I want to make sure the computer doesn't overheat, as you know. And then we'll switch over to the TV. Let me test the TV, make sure that's all working okay.
B of A with an interesting note saying they pay particular attention to Waller, who recently said core inflation.
Give me a thumbs up if you can hear this all right, guys.
Require probably some more tightening to get that going down.
Waller's been sort of leading in the we need to do more on inflation camp, and he's a governor, so he gets a vote every time, which is why it was somewhat surprising that it was.
Brilliant. So it sounds like the sound is good. If at any point you have any issues with sound, let me know, guys. We're going to be here for a while. Get comfortable. Get yourself a coffee. Keep this on in the background while you're doing whatever you're doing. And let's find out what Jerome Powell is going to be doing. Yeah. So from a charting perspective, let's just pop this TV to the backside. He's due any minute now, by the way. So as soon as he does and I see it on my other monitor, I'll bring it up on screen for you guys. But we're in this falling wedge, right? Bullish continuation pattern, breaking nicely to the upside. Now, this is not a normal breakout. I mean, this is a nice technical breakout, but it's not a normal breakout. It's very extended. I mean, a normal one is something like so, come back around and start working your way up. This is very parabolic. So again, there will be a calling off at some point. Nobody ever thinks there is a calling off, but there is, right? If you bring out the EMA ribbon, we're very extended here on the 4 hourly. So don't be surprised to see this even call down to kind of 27.4, 27.5. Perfectly normal, right? Coming back to its EMA ribbon for support. If you're looking for entries, that's where I'd be looking for entries as well. I wouldn't be chasing it where it is right now. Certainly not. I'd be waiting there at the 4 hourly EMA ribbon to see if I can pick some up around this point. Now, right now, super extended, you know, but the question is when you're this extended, it just means you're weaker when you come to the next resistance. So we're coming now, we broke through 29, which is great. Next one's at 30 and then 31. Once you clear 31, then you start looking at the exciting price target of the full pattern, which brings you up towards 37, right? But in doing so, in playing that pattern out, you'll then play out the big cup and handle pattern. Remember, we're breaking out of the handle right now of the big cup and handle pattern with neckline around 30,000. If we can break this bigger pattern, then we can work our way even as high up as to 45, right? So all to play for right now. Exciting times in the market. Of course, there are some worries as well. I did share my worries in my video about TradFi checkmate. Make sure you go watch that as well. I'll share my perspective on this kind of TradFi takeover. But look, money's flowing into crypto, right? Money's flowing into crypto, and that's a positive sign given that just months ago we're sitting at 15,500 towards the end of 2022. Cool. Let's see what you guys are saying in the chat. Do let me know where you guys tuning in from. Which countries do we have represented in the chat? Please do smash up the likes on the way in as well, guys, so I can continue to bring you more live streams like this. Coinmaster, good to see you. EOT, good to see you again. Barney, afternoon, everybody. SS, oh man. Lloyd, Roger, Spencer, afternoon, sir. How will the markets react? I'm not in any trades right now. This is the thing. Remember, the key things generally markets look for is, does he give any clues about his monetary policy? How's he feeling about inflation? How's he feeling about the labor market? How's he feeling about GDP? All the clues which will kind of give us a clue around where's his mind at. Is he our friend right now? Is he not our friend right now? Is he still in a tightening mode? Is he hawkish? Is he dovish? These are the kind of clues we listen out for. Christian says 29.5k resistance was my prediction, but I'm usually wrong. Wakaz, oh man, let's go. Good to see you. Shoaib, good to see you. Ian, good to see you. Mike, good to see you. Liquor, good to see so many familiar faces building up in this community. Shout out to all of you guys who support this channel and the content I put out. But do smash up the likes. Let's get more likes in here. Let's see if we can get a bunch of different people joining this live stream so we can understand how Jerome Powell moves the markets. Again, as soon as Jerome Powell's ready, I will switch over, guys. Nash's in sunny California. Hadi is in Jordan. Coinmaster is in Yemen. Greetings from Estepona, Spain. Cool. Junebug, do you see Bitcoin ever going back to 15.5? It's very difficult. If you're a bear right now wishing for Bitcoin to go back down to 15,000, I mean, everything is against you right now, right? You really are fighting the trend. You were close to losing the EMA ribbon, and now it's bounced powerfully off its EMA ribbon. Look at that bounce here on the EMA ribbon. If you're a bear, you've got a lot of work to do. First, you have to reject at 31. Then you have to show some weakness, create lower highs to the downside, and eventually aim in a couple of weeks or months to flip this EMA ribbon bearish. And then you can worry about 20 and then maybe 15,500. So to answer your question, very, very difficult for Bitcoin to get back down to 15,500. And again, you have to remind yourself, and I said this time and time again over the last few months here, it took a very specific set of circumstances to get Bitcoin down to a level where it was at 15,500, right? It took FTX, it took Celsius, it took Voyager, it took Terra Luna collapsing earlier in that year. It took inflation at record highs. It took a Jerome Powell doing a record lift-off in terms of interest rates. It had the Russia-Ukraine backdrop. You had so many things going on that led to that unique set of circumstances for Bitcoin to fall down to 15,500. And now, with institutions clearly not even trying to hide the fact that they are in on crypto and they care about Bitcoin, you're seeing a move. And one other thing I wanted to share with you guys is you need to see, where is this move going? What did I say? I said that it was clear that from the SEC documents, they want to protect Bitcoin, Ethereum, right? They're pro Bitcoin, Ethereum. They're not pro these other coins. They're trying to deem them all as securities. So I said that they're likely to set up an exchange, right? They're likely to allow Bitcoin, allow Ethereum, maybe a few other altcoins which they deem as not being securities, right? And what do you notice? You're noticing straight away that anything which has proof of work to do with it, you saw Bitcoin Cash running, you've seen Cadena having a positive move to the upside, right? You're starting to see a lot of these proof of work plays start to move to the upside and benefit. I mean, look at Cadena, up 16% today. Why? Why is it up 16%? It's up because of that exact narrative. If it's proof of work, they've got far more of a case to say, oh, we're like Bitcoin. You've deemed Bitcoin a commodity. We use the same methodology. Or in Bitcoin Cash's term, we're a fork, right? And then we also saw that Litecoin was listed on the exchange that's being backed by Fidelity and Schwab, and so is Bitcoin Cash. So you're seeing some moves in those projects as well. But otherwise, altcoins are not responding, right? Altcoins, apart from those ones which feel like they're benefiting from the TradFi, they're not responding. This Bitcoin-led move, you've got dominance really rocketing up. Again, not a surprise, right? We knew what dominance was going to do. We called this. We zoom out here to the weekly and bring my drawings back out. Let's pop this EMA ribbon off. We spoke about this. I've not touched my drawing. I said we need to break 48, come get a retest, break through 52, and head towards 59. So many videos where I've said that, right? And this is Bitcoin setting the trend. And again, I've even drawn out what happened historically. We went from the 35% level, which we didn't get as low as this year round, all the way up to 73%. So there's a clear path here for this to go up to 73% as Bitcoin leads the charge. And then eventually money's going to rotate to alts. So I'm really not bothered if my alt's keeping up or not. All I'm bothered about is, do I believe in that alt? Do I have conviction in that altcoin? And do I therefore think that that alt is going to survive? If it's going to survive, I'll keep in my portfolio. It doesn't need to be green. If it's red, great. I'll add some more if I need to. I'm just going to leave it there. Let Bitcoin do its thing. That's why you have Bitcoin as anchor your portfolio, and then wait for the rotation back around. Let's switch on over now to Jerome Powell and see what he's saying.
Continue to pound the table that what we're seeing, if everybody's worried about tightening monetary policy, that has to be a good time to be a lender. You can't have it both ways. Like, if conditions are tightening around from the banks and from the Fed, then being a lender is a great place to be. But I do think equities perform. I think Japan's going to continue to break out. Small cap, the market's telling you that the breadth is expanding, so you're getting a catch up there.
Interesting here. We're seeing a little bit of a sell-off here coming into Jerome Powell's talk. Seeing Bitcoin here just on the left-hand side. That's a 5-minute chart you're looking at there on the left-hand side for Bitcoin, and on the right-hand side you're looking at the QQQ, which is the Nasdaq's ticker. Okay, so again, kind of calling off. Everybody gets scared that Jerome Powell's going to dump the markets. Traders like to use it for volatility, and again, when they switch over to him, you can see him just sat there. I will unmute the fella so we can get bored by him and he can put us to sleep. In the meantime, I'll take some of your questions. Please do smash up the likes, guys, if you appreciate this content. Make sure you subscribe if you're new around here. Do subscribe. We do a bunch of TA, we do a bunch of technical analysis, fundamental analysis, all things wealth building, crypto, whatever I'm interested in, I'll throw it out to you guys and see if you can benefit from it. Yeah, NASA said Casper as well. Hadi says, what if the SEC rejects the institutions? And look, it's an interesting thing. BlackRock's not in the business of getting rejected, right? And this is why the market is feeling so positive about this, because of the person filing. If it was just Invesco filing, they've been rejected before. Markets wouldn't be that excited. It's the fact that BlackRock very rarely gets rejected. And that's why the market's feeling positive. Of course, it's a case you have to account for. But the question will be, SEC will have to reject it with a reason. BlackRock will fix the reason, and eventually they'll get it through, right? And then once they get through, everybody can then have a spot ETF because they can copy and paste the solution that BlackRock figured out for them all to get an ETF. And then that just increases all the on-ramps for institutions to come into Bitcoin, but controlled by TradFi. Like I was asking, how is Phantom looking? Phantom's looking all right, up 4% here on the day, sitting at 28 cents. Again, I'm not too concerned about altcoins. Yes, some of them are moving. It's not an altcoin-led move. It's a Bitcoin dominance-led move. Dominance up by another % today. And that's the focus of this market right now. Do you have any update on the SEC Binance case? No update. I mean, they came to a compromise on the freezing of assets, and that's going to continue. It's going to take a long time. As and when there's updates, I'll bring you guys videos. But nothing here in the immediate term on that. It's going to take a long time. These cases are not going to get resolved very quickly. Do you think Ethereum dominance will go up? Yeah, Ethereum dominance will increase as well. Bitcoin dominance will increase, Ethereum dominance will increase. Because again, Ethereum's not listed in the same mess as the rest of these altcoins. So the safe plays right now, if you think about it, if you're somebody with big money, is Bitcoin, Ethereum, right? Those are the safe plays. And also by looking at the exchange that those TradFi companies partnered with, the EDX markets, they said they're going to list Litecoin, they're going to list Bitcoin Cash, and that's why you're seeing a little bit of a movement behind some of those as well. Dana says, would love to see some more content around our lowly Phantom. Let me know what type of content do you want to see. Make sure you're involved on Twitter in our Discord community. Let me know what type of content you want to see, and I'm sure I can spin something out for you guys. Reckless Danny says ADA is close to a run. ADA's up 2.8% today, not looking too bad. Let me just switch over, see what these guys are saying.
We have them going kind of 5 3/8 or 5.5, but not to 6, because ultimately there is some level. When you go back to 94, that's what happened where people pulled their money out when you raise rates really quickly. That's not our base view, but when I think about what could go bump in the night, there's clearly office real estate, there's the Fed has to do more, and then there's just ongoing geopolitical. But people are negative. They've been negative. They pulled back earlier in the year, and then they really pulled back after SVB, and you've had a pretty good rally in both equities and credit. And our message is just keep it simple, but small cap, Japan, private credit, infrastructure, there are things to do where you can make a decent return.
But you say equities will do well in an environment where the Fed has to do more, which is the message we're expected to hear from the Fed chair today, and while other central banks are clearly not done either. But
the market is a discounting mechanism. Last year, 84% of the top 25 central banks were raising rates. By the end of this year, it's going to be 8%. Do you want, you think about headwind or tailwind. If it's really 8%, markets are going to do okay.
Even 8%. Though that, but shouldn't you do that on a dollar weighted 8%
it's the
of
most
what?
Important
of the market
8%.
cap?
But there's global money tightening at the fastest. We just went through 2021. We had what was pretty speculative conditions. We had every one of the top 25 central banks raising rates at a record clip. That is going to slow down to just a handful of them into next year. What did Powell tell you? We're in the strike zone. We just need to see the difference between, is SVB going to take liquidity out of the system? What's happening with wages? But I think the body of work of the Fed's actually been okay. But it's going to, my personal take is I think it's going to be really hard to get to 2%. And I think that where we end up is they're above 2%, and it gets back to their average inflation targeting that they laid out during COVID. We were under, they missed their target for, I think, 5 years in a row, about 80% of the time. And so it doesn't totally surprise me we're above it. The question is do you want to sit on the sidelines during all of this? And I would say the time to be super negative was the end of 21. When the S&P goes down 25% or more, you have about 100% hit rate of outperforming on a 3 to 5 year basis. Most of our capital is 5 to 7 year capital. So what are we trying to get right? Big themes around digitalization, automation, energy transition, services recovery. On a 5 year basis.
NASA just said there in the chat, my mortgage has gone up by £300. Just wait till people see the real struggle. It's true. And this is the bit that Jerome Powell and central banks across the world have to get right. I know, NASA, you're here in the UK. UK's inflation is horrible, right? US is in a slightly better situation if we're to believe the numbers that are being put out. But Jerome Powell and other people like him, the other central bankers, have to get this right of how they pivot, right? How do you now make sure you don't damage the economy, you bring inflation down, you don't damage the economy, and then you get out of it and you start stimulating again? That's going to be the balance that they have to figure out, which is not so easy.
On the heels of the Federal Trade Commission taking action and filing suit against Amazon for what they say is enrolling consumers in Amazon's Prime service without consent and then sabotaging their attempts to try to cancel. They say that the company's knowing failure to address non-consensual subscriptions and the cancellation trickery is behind this particular move. They also say and point out that Amazon has knowingly duped millions of consumers into unknowingly enrolling in their Prime service, specifically that Amazon used manipulative, coercive, or deceptive practices to get people to subscribe to that. FTC Chair Lina Khan said in the suit, quote, Amazon tricked and trapped people into recurring subscriptions without their consent, not only frustrating users, but also costing them significant money. These manipulative tactics harm consumers and law-abiding businesses alike. Interesting, they also go to point out that in the complaint, the FTC also...
Interesting point here by Junebug, SS. Has the focus of investors changed now to new chains like OP, ARB, SUI, that they are rebounding at a faster rate than like Phantom? So I've heard this premise before. I've seen other influencers kind of promulgate this idea as well, that, you know, you kind of move across the different narratives. Look, if you're following what the average retail person is doing and you want the latest hype trend coin, then yeah, they kind of move across to new narratives and they have their moment in the limelight and then they disappear. No, like a kind of one-hit wonder, right? But if you're looking for the next big project, if you're looking for the next Bitcoins and Ethereums, ones that are going to last many cycles, that's what I'm looking for, right? And that's why the projects that I choose and pick have to have the potential of not just getting a little bit of attention then fizzling out. No, I'm not interested in that. I want them to be able to survive bull market, bear market, bull market, bear market, be around for 6, 8, 10 years and build wealth over a period of time, right? I don't just, like, look at Ethereum. Ethereum's a great example. Had you invested in Ethereum in early days, you'd be doing really well. Same for Bitcoin. Now, the rest of them so far have only built wealth for many people in short sprints up, and then they've kind of not made it again, right? That's because the retail crowd are like just swarming around looking for the next kind of thing. And whether it's a meme coin, whether it's an exciting project, they jump into the next narrative. I'm looking for sustainable narratives, which I can add to my portfolio over time. That's different.
Listen, Lina Khan wrote her seminal piece on Amazon when she was at Yale Law School. One of the key reasons why at such a young age she was elevated to run the FTC under the Biden administration. And as Dom said,
why is Jerome Powell always late? Reckless Danny says, is Andre back a Phantom? Yes, he has been for a while. We made a video on that a long time ago. Barney says artificial pumped. Yes. Linde says, what about Cadena? Cadena's moving well. Again, proof of work, right? With it, and then, again, if you go back to my videos, there's a reason I say stuff. I said the reason I'd have Cadena as a small part of my portfolio is because if proof of work is right and that's the way everybody's going, then you need to have some proof of work in your portfolio outside of Bitcoin, right? And again, you're seeing that. Today's a narrative where proof of work is moving on the back of Bitcoin Cash, on the back of Cadena, because Bitcoin isn't in this mess, right? So people are looking, okay, if all these other proof of stake ones are being deemed as security, maybe the proof of work ones are going to get away with it, right? And that's why you're starting to see that. It's important to diversify. Lindby, is Cadena sustainable in your opinion? Yeah, it's got the potential, but I've been disappointed by the lack of progress, right? They need to really plug on and do more. Again, I've broken that down in separate videos previously. What is the bad news we're waiting for that will bring this price? The price can come down if Jerome Powell gives us something to worry about, right? Like if Jerome Powell gives us some tension around being hawkish or suggesting he's going to have to keep rates higher for longer than expected, which he's kind of told us in the last meeting, right? 2 more rate hikes this year. These are the kind of things that can affect the market. Guys, do smash the likes and subscribe if you appreciate this type of content, bringing you Jerome Powell as and when he comes live. He's already 20 minutes late, standard. I should wait until like they actually start speaking, then come live. But we've covered off some good topics here, so that's all good. Let me know if you have any questions in the meantime. Do smash up the likes, guys. There's 130 of you concurrently watching, but only 42 likes. Look, if the stream doesn't do well for you, you can unlike. But just like it now up front, and if you don't like it later, you can unlike. Hopefully that's a deal. Got a really important video coming out later today on 12 side hustles that can generate you $12,000 a month. Really important video. I will be posting that later on today, and this will be like part of a series of other videos I will be creating, because look, crypto is amazing and crypto will build you wealth as well, but you need other streams of income, and this is where I'm going to be different from other YouTube channels. They'll just focus on telling you crypto. Not everybody can do day trading. Not everybody can build wealth through that way, but if you can create a cash cow elsewhere, if you're a good plumber, if you're a good graphic designer, if you're good at something else, you want to take some of those profits or the income, the active income, and investing it in crypto. That's different to you being a day trader, okay? Very different. If you're good at day trading and you want to try trading, Ijaz.UK/Bybit, right? You can learn trading. I believe everybody can learn, just not everybody will learn, right? I've posted enough free content that you can learn. You can take the TA course, Ijaz.UK/TA, and you can learn how to do TA, right? Look at the TA course we've just called here over the last couple of days. We've called these moves perfectly to a T, guys. And all you had to do was download, set yourself up on exchange, link in description, look at some of these moves that we're doing, and you would be quids in, right? We spoke about this symmetrical triangle before it broke out, right? We spoke about this falling wedge before it broke out. I'm giving you the structure. Just trade the structure in either direction, right? I personally don't short, but if you guys want to short, right? Trade this in either direction. I've given you the structure. It's here. And then I've even taught you how to spot these things in the course as well. Ijaz, do you hold any real estate? Yes, I do. Again, part of my portfolio, right? I'm not averse to anything. You got some of these crypto bros that are like everything in crypto. Good for them. For me, it's just an asset class, right? It's an asset class. It's a future asset. It's an asset class which I think has the most potential to grow, right? It's one that I'm the most excited about, but I still can't be silly. I can't not have money in startups. I can't not have money in companies, in stocks, in dividend-paying companies. Of course I do. And when you get to a certain net wealth, you have to. It's silly not to. Now, if I was a small investor, I just started, I don't have much to lose, then I'm going to be a bit more risky, right? Of course I am, right? If I'm younger, if I've got less responsibilities, of course I'm going to want to be risky. But after you build a certain bit of wealth, you kind of bring the risk levels down into something more sustainable, because option number one is not to lose money, right? It changes. You want to then stop losing money and grow sustainably. Now, when you're a young buck and you're just getting started, right? Or even if you're not young, but you're just starting on your journey, you've got a couple of grand, then you're going to take risks, right? Because $1 grand on 6% is not going to go anywhere, right? Let's see now what we've got here.
Well, I think they need to read into it only so far.
He's saying something, but we can't hear it.
I did see some people, by the way, changing their outlook for the BOE to raise by half a point and bringing it up even faster.
So how this works is he'll start with his prepared statement, which he'll read out. You can download the transcript of it as well. And then we'll get the questions, which is where the interesting bit will happen.
And that's apart from what's going on cyclically around the world. So I think that Brexit issue, which is probably raising costs internally and creating a step function of inflation or higher prices to the price level, is something that is a big factor over there in England that we don't have a problem with today.
That is one part of the discussion, whether or not the UK, thanks Steve, really is an island of inflation, and whether it's policy mistakes that have something to do with that.
For sure, because, I mean, Steve's right. They're going through Brexit, and nobody else is dealing with that. So we look at Europe, and Europe has shown moderating inflation as well. We got some lower PPI numbers, for instance, out of Germany lately, which people were really encouraged by. So we'll continue to watch everything. You know, those that are saying Powell should have paused a long time ago are looking at diffusion indicators for prices on regional Fed indexes. There's a lot of data you can parse around inflation. It shows it's moderating, but still too high. Let's go to Powell now on the Hill, who's going to take questions.
You're right, of course. We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That's really it. You know, we were at 75 basis points for several meetings, then we were at 50 basis points, then 50 basis points, 25 basis points at 3 consecutive meetings, and now we're moderating that pace, much as you might do if you were to be driving 75 miles an hour on the highway, then 50 miles an hour on a local highway, and then as you get closer to your destination, as you try to find that destination, you slow down even further.
Okay. So it is more data is necessary for the Fed to make these decisions, and that's one interpretation, but thank you for a broader view there. I also want a broader view on this question of the Vice Chair for Supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test, even, striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the Vice Chair of Supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the Vice Chair for Supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amounts of capital he's talking about, the concern that this is pro-cyclical at a time where our economy with higher rates is you're measuring what's happening in the broader economy, and at the same time we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet. And so I can't really get into specific details today.
Well, we'd like your thinking, Chairman Powell. That's what we'd like.
What I can share is, principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those, and I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile, and particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have high levels, very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time. And I think there's broad agreement, as you point out, that capital is strong. And, the question there will be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But, there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system. And we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Well, this committee would expect to see a quantitative analysis of whatever the capital charge is going to be. We would expect that from the Fed, as we do from other regulators. With that, we'll now recognize the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you very much. Chair Powell, at this committee's last hearing on digital assets, my Republican colleagues proposed a stablecoin bill that would create 58 different licenses with federal regulatory approval over only 2 of the licenses. The remaining 56 licenses can be issued by each state, territory, and D.C. with little or no federal oversight, regulation, and enforcement. This proposal takes state preemption into a whole new level. It effectively allows every state to preempt another state. DC-based coins, for example, would be sold to individuals nationwide, and New York or North Carolina regulators could do nothing to protect their own residents, while even the Fed would be severely hamstrung in providing any oversight. I've argued that we should allow states to be part of this process, but we must have a strong, enforceable federal floor with a role for the Federal Reserve to approve and provide oversight of payment stablecoins issued by non-banks in order to ensure that consumers are protected. Such a framework is similar to our dual banking system, and it would ensure that non-banks and banks are treated the same. We should also bear in mind that payment stablecoins are a new form of currency intended to allow individuals to pay for things with them. As such, do you agree that it is important for the Fed, as our central bank, to have a chance to approve or decline any state-licensed non-bank entity before it starts issuing payment stablecoins nationwide?
Well, first of all, let me say we appreciate that we've been able to offer our views on these things to your staff and also the majority staff, and we appreciate the consideration that's given to our views. We do see payment stablecoins as a form of money, and in all advanced economies, the ultimate source of credibility in money is the central bank, and we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role and allowing a lot of private money creation at the state level would be a mistake. But nonetheless, again, I do appreciate that we've been able to be heard and share our views with the committee.
Well, thank you so very much. I am appreciative for that clear answer. The next question that I have for you is a bit unusual. But one of the reasons we push diversity is because those things that have not been discussed, issues of people of color, etc., have not been dealt with. I'm going to throw you something that you would not expect. Earlier this week, our nation celebrated Juneteenth, which Congress recognized as a national holiday for the first time since 2021. The holiday celebrates the day enslaved African Americans in Texas heard that they were free, 2.5 years after the Emancipation Proclamation was issued. To this day, Black Americans grapple with enduring racial economic inequality that has its roots in slavery, as evidenced by the black-white gap in net worth and home ownership rates. My bill, the Federal Reserve Racial and Economic Equity Act, would require the Federal Reserve to carry out its duties in a manner that supports the elimination of racial and ethnic disparities in employment, income, wealth, and access to affordable credit. Now, the Fed has a number of duties to pursue maximum employment in the monetary policy, to supervise banks for compliance with our fair lending laws, and to ensure the Community Reinvestment Act is administered in a way that puts an end to discriminatory redlining practices by banks. Do you agree with me? And Atlanta, Federal Reserve President Raphael Bostic, among others, that the Fed has a role to play in addressing racial economic inequality as it carries out its work until Congress passes this bill? What steps will the Fed can you take to address racial and economic inequality?
So we do consider inequality in the economy as part of our thinking about decisions, but ultimately, and those are certainly highly valuable social goals to pursue. I would say our ability to take part in addressing those issues is fairly limited. We have one federal interest rate that we set. We do try to keep in mind, as you know, not just the aggregate national level of unemployment or employment, but also that for different ethnic groups. So we take that into account. But I would think, and I think that's just part of making sure that we feel like we have all Americans in the room with us when we're making decisions on monetary policy. I will say, though, I think other agencies are better suited to address these deep issues.
Thank you. We must have this continued discussion on racial equality. I yield back.
The lady yields back. We'll now go to the Vice Chair, Mr. Hill of Arkansas, for 5 minutes.
I thank the Chairman of the committee and Chairman Powell. Great to have you back before the committee. And This morning, you've reiterated, and certainly Vice Chair Barr has reiterated a number of times, that the banking industry here in the United States is well capitalized. And in fact, capital levels have remained robust despite COVID-19, with a 20% plus unemployment rate increase and a 9% output gap. They've remained stable through government shutdowns. They've remained stable through severe stress testing. And maybe more importantly, just in the last few months, since the first week of March, you've seen strong capital come into play as we've grappled with the reality of a 40-year increase in short-term interest rates and that impact on banks. But as the chairman said, Michael Barr continues to say he wants to increase capital requirements on certain financial institutions. And in March, you testified that you said, I will do everything I can possibly do to bring people together, meaning on the Board of Governors, in consensus and have a capital framework that could be broadly supported. So to what extent have you and the other governors been involved in this so-called holistic review by Vice Chair Barr? Has he briefed the other members of the Board of Governors thus far?
Yes, and we've all been briefed by staff, really, on the proposals. But as I mentioned, they're still somewhat in motion. But yes, we've been briefed.
So you would say those proposals are still under consideration and that there's no final decision that's been taken by the board?
No, well, no. Once the proposals really do settle down and are written up, they'll come to the board for a full discussion and a vote.
Has the Fed board reconstituted now the Committee on Supervision and Regulation? The membership of it?
Oh,
who's on that committee now?
So that committee is chaired by Vice Chair Barr, and it also includes Governor Jefferson, and it includes Governor Bowman.
When you look at capital in the U.S., and I look at the globally significant banks here versus other places in the world, would you say that the U.S. banks, the U.S. G-SIBs, are better capitalized than their global peers in Europe or in Asia?
So we're certainly at or near the top of the league table. I think there are a couple other jurisdictions that also have broadly similar levels of capital strength. But yes, we're at the top of the league table.
I looked at it this morning, and U.S. G-SIBs have 11.3% capital without any kind of modification compared to their European competitors at only 9.9%. So would you say that we're better capitalized than the European banks, the European G-SIBs?
I hate to call out the other jurisdictions, but I would say our banks are very strongly capitalized and also competing quite successfully globally outside the United States.
Yeah, I agree, and I think we've strengthened capital, we've strengthened our supervision, notwithstanding the problems that we saw this spring, which we've talked about ad nauseum here. But that capital standard does make American banks, I think, stand out. And wouldn't Basel, the so-called Basel III holistic reforms, wouldn't it be better if the European banks did a holistic review and actually got their capital up to American standards?
So I think they are bound by the same. No one's bound by these, but they have agreed to follow the same standards, and I think they're going through the same process we're going through.
Same topic. Are the FDIC supervisory process and the OCC supervisors, are they involved and engaged with Vice Chair Barr in looking at this, quote, holistic review of capital adequacy?
I think,
in other words, are they providing their input to the Vice Chair for supervision in their own views on this topic?
On the regulatory proposals that are relevant to them, yes. I think on the capital proposals, yes, I believe so.
And you made a comment a minute ago, I think, to Chairman McHenry's questions about that you'd like to see rules and supervisory rules consistent over time. And I think that's frustrating here. We see change in administration. Sometimes we see change in rules, which is, I think, frustrating to the private sector and to market participants. I note that the Biden administration says that the Financial Stability Oversight Board should now base their decisions on size as opposed to activities. And for several years now, we've had an activities designation and a cost-benefit analysis. Do you think the activities designation gives supervisors more discretion at FSOC to select who should be deemed under their supervision?
So I actually think that
in other words, is size alone, should we be looking only at size, or should we look at cost-benefit analysis and activities? And my time's expired. If you'd answer in writing,
Okay.
I would appreciate it. I think this is an important issue. I yield back, Mr. Chairman.
We'll now go to Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman. Chair Powell, at your press conference last week, you stated, and I quote, "The committee is completely unified in the need to get inflation down to 2% and will do whatever it takes to get it down to 2% over time." Some analysts have interpreted this statement as the FOMC's willingness to trigger a recession in order to get inflation to 2%. How would you respond if this is a fair and accurate interpretation?
So our statutory goals are price stability and maximum employment, and we are dedicated to using our tools to achieving those. In the case of employment, we still have historically low unemployment rates and high employment rates now, high participation, a very strong labor market. We're very far from our inflation target of 2%, and we're very focused on getting back to 2%.
And how does the FOMC takes into consideration the impact of rising interest rates on LMI communities and small businesses when determining monetary policies?
So we only have one interest rate to raise or lower. It's not true, but mainly one main interest rate to raise or lower, and it applies to everyone. But I would say that inflation hits LMI communities and people generally at the lower end of the income spectrum much harder than people in the middle or at the high end, because high inflation can get you into trouble right away if you're living on a fixed income just to cover the basic necessities. So it is for the benefit of those people that we must get inflation under control. It's for the benefit of all Americans, but particularly for those people. And we keep that in mind as we are strongly committed to getting inflation back down to 2% over time.
Well, and they are the same people that are having a hard time accessing loans, the same with small businesses. Chair Powell, Vice Chair Barr's report on the Fed's review of Silicon Valley Bank states that while there was regulatory tailoring conducted in response to S2155, there was also, and this is the part that really concerns me, a cultural shift at the Fed under the direction of the previous Vice Chair for Supervision, Randy Quarles. According to the report, this shift included pressure to reduce burdens on firms, meet a higher burden of proof for a supervisory conclusion, and a need to accumulate more evidence than in the past. As chair during that period, were you aware of this cultural shift and the impact it was creating?
So I think we learned from the Silicon Valley failure and the others that there is going to be a need for stronger supervision and also regulation for banks of that size. And I'm committed to learning the right lessons from this exercise and to forthrightly implementing changes.
Were you aware of the cultural shift?
So I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
so
is
you
always
disagree with Chair Barr's report in that respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back in the day.
How often were you meeting with Vice Chair Quarles?
I reasonably frequently. We sat quite near each other.
And never discussed the cultural shift.
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall.
Well.
So what
I had no part in. I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps did you take proactively to meet with regulatory and supervisory staff?
Well, I think we're taking significant steps now. We're as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that there are situations in which we need to be more forceful and more proactive. Not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated.
My time has expired.
The gentlelady's time's expired. We'll now recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. I just want to start off by asking a few yes or no questions. Was the Silicon Valley Bank failure a result of a liquidity issue?
I'm sorry.
Was Silicon Valley Bank failure a result of the liquidity issue?
Among other things, yes.
Signature Bank failure, the result of a liquidity issue?
Yes, I mean, that's not, there's also a lot of very bad management decisions being made here.
But liquidity. First Republic, was that a failure result of a liquidity issue also?
Among other things, yeah. I mean, I wouldn't say just liquidity.
Well, all right. Were any of them a failure of having too low capital levels?
So let's go to Silicon Valley Bank. You know, the issue that triggered the run initially was the presence of significant losses in their securities portfolio.
Yes.
And that is that is a capital issue.
So they had too low a capital, or the requirements. So what?
They weren't required to, as you know, they weren't required to take that into account in their capital. But I think if you remember, what people were focusing on was these portfolio losses, and then what people weren't focusing on was the fact that they had in excess of 90% uninsured deposits, and that's what caused the run.
So would increasing capital requirements for Silicon Valley Bank or any of these other banks or all banks together, would that have stopped these banks from failing?
That's a hypothetical, unknowable question. I think it might have helped. I think it might have helped, but
how much then? Increasing it by how much would have helped?
It's very hard to say. Very hard to say. I mean, clearly the main issue there was a failure of management to follow up, a failure of supervision to require them to follow up, and really the liquidity regulation was just not appropriate. We needed to have stronger regulation around liquidity and uninsured deposits.
So last year you said the banking system is very strong, well capitalized, highly liquid, does a much better job of understanding the risks that it runs and managing them. And just today you said the banking sector seems to be strong. Do you still stand by those statements? I mean, just said it today.
Yes.
So, yep. Last month, Vice Chair Barr appeared before this committee, and he agreed with you. He said overall banks have a strong capital and liquidity. Secretary Yellen has said similar things. But
sorry to interrupt, guys, but just very interesting here how you're seeing that the NASDAQ is falling. TradFi markets are falling here, and you're getting a rise in Bitcoin. So Bitcoin's catching up. Remember, TradFi had its moment and Bitcoin wasn't moving. It's almost like they're mean reverting now back into equilibrium.
What's the size of the increase for capital requirements?
No. What I meant to say, what I thought I said was that any increase above these levels would need to be shown to be justified.
So I understand, and you have a vote as whether or not what this proposal you'll vote on whether or not. Do you personally think that an increase is necessary at this time?
Do I think
that an increase in capital requirements is necessary at this time?
Look, I'm going to react to whatever the proposal turns out to be in the end and give it my best assessment. And also, that's what I'll say.
Okay. You just also said that credit is tightening. Won't increasing capital requirements further tighten credit?
Over time, I mean, the thing about capital requirements is if we put a proposal out this summer, let's say, it'll be quite a while before that proposal is, agreed and among the agencies and then voted on, and then it'll take some years to come into full effect. So I would think, whereas interest rates, for example, have immediate effects on financial conditions and then reasonably quick effects on economic activity, capital requirements are a much more sort of medium-term, longer-term thing.
So I'd like to move on to what the impacts on lending, raising capital requirements would have. According to an academic literature by the Basel Committee on Banking Supervision, a 1% point increase in capital requirements could potentially reduce annual GDP by up to 16 basis points, showing that higher capital requirements come at a cost and could have significant impact on the U.S. economy. I discussed this with Vice Chair Barr last month, and expressed my concerns about what the impact of increased capital on the real economy, but he didn't answer the question directly. We just need to, we're hearing from all sorts of industry that these increased capital requirements at any level would have a further tightening on lending. And if that happens, and I'm hearing from everybody, if that happens, it's going to be a real disaster. So I think anything that the committee proposes, if you could come back and brief us on before it's finalized, we would appreciate that very much, sir.
Gentleman's time has expired. The gentleman from Missouri, Mr. Cleaver, is now recognized.
Thank you, Mr. Chairman. Welcome, Mr. Chairman. Thank you very much. This is probably Economics 101, but a lot of people in my district are misunderstanding 101 along with me. In May of this year, unemployment remained at 4% for the 16th consecutive month, and at 3.7%. This means that unemployment remained at or below 4% for the longest stretch in 50 years. In the U.S., the job openings rate has fallen by more than 1.5 percentage points from its peak, while the unemployment rate has crept slightly lower. In other words, the job openings decline, but so does joblessness. And I'm wondering if there was any expectation that this would happen, this would occur.
There is an expectation that the level of the ratio of job openings to unemployed people has been in historic territory, all-time highs for a while now, in the last year or so. And there is an expectation that it will come down. There a while ago there were 2 jobs for every unemployed person. Now we're down to 1.7, I believe, or 1.6, and that still speaks to a historically tight labor market, where their demand for labor still very substantially exceeds the supply of available workers. So we do expect as things, and that, by the way, that's a way that the labor market can become less tight without having unemployment go up.
I'm sure you're hearing this all over as I am, and that is business people. I have a good friend who has number of barbecue restaurants in Kansas City, and he is constantly telling me how difficult it is to find workers, to the point where he did something he thought he'd never do, put a sign out in front of his restaurants, job openings. And are there particular industries or sectors of the economy where we would expect this sentiment to be particularly true?
No, and that is right. That is, there's still a significant labor shortage. The surveys at the aggregate level show that it's not as bad as it was 2 years ago. So gradually, businesses are reporting that they're having better able to find workers. Workers are reporting that they're not quitting their jobs as much as they were. That's a really good sign of how tight a labor market is how much people feel free to quit their jobs voluntarily. So those things are all suggesting a gradual cooling and a gradually getting supply and demand back into alignment. But we're not there yet. We still have a significant excess of demand over supply.
Are we also finding that I know in Missouri, that in spite of the fact that there is some jelly-like movement with the economy, people are still willing to go, in our community, still willing to go out and buy homes. I mean, we're not having difficulty in terms of people going out getting loans, even with the interest rates rising. if all of this continues, if the consumers are constantly paying whatever the interest rates might be, are we going to get stuck just continually going up?
Well, no, I don't think so. So in housing in particular, there is the housing sector nationally has flattened out and maybe ticked up a little bit, but at a much lower level from where it was, with rates as high as they are. So supply and demand there are getting back into alignment. And I do think that, housing inflation is set to come down as we move forward. There's a particular way that the inflation is calculated there, so that you're really only looking at you're waiting for leases to come due and roll over at much lower levels of increase. So we think housing inflation will be coming down significantly over the course of the rest of this year and next year.
Thank you, Mr. Chairman.
Gentleman's time has expired. The gentlewoman from California, Ms. Kim, is recognized.
Thank you for recognizing me, Chairman. And Chairman Powell, thank you for joining us. I appreciate your comment to price stability and commend your efforts to reduce inflation and make life more affordable for all Americans. Thank you for that. The 10,000 small businesses survey of 2,000 small businesses found that 77% were concerned about their ability to access capital. So with that in mind, do you think it's appropriate for the Federal Reserve to increase capital requirements at this time? And I know this was discussed earlier, but what specific analysis has the Fed conducted so we can determine the impact of this warrantless regulatory action on small businesses and other marginal borrowers?
So with capital standards, it's always a trade-off. The more capital means a more stable, more sound, more resilient banking system, but it also at the margin can mean a little bit less credit availability, and also the price of credit can be affected. And there's no perfect way to assess that balance. Obviously, the answer is not zero capital, and it's not 100% capital, so it's somewhere in the middle.
Thank you. There are estimated about 1.5 trillion of commercial real estate loans that are maturing in the next 3 years. And declining demand and the prevalence of work-from-home policies are putting a strain on commercial real estate market. The bulk of commercial real estate loans are held by smaller and regional banks. So is the Fed thinking about policies that could provide time for commercial real estate loans to be refinanced? And could an increase in capital requirements reduce liquidity in the commercial real estate loan market?
So we're very focused on the commercial real estate situation. You're right, of course, that a good portion of the commercial real estate loans are held in smaller banks. And supervisors are very much engaged with those banks, and it's particularly banks that have a high concentration. That's what we look for among the smaller banks, and there are some of those. But there's a playbook for working your way, working your way out of these loans, and it's particularly in the office sector where work from home is still a pretty material factor in some areas, as you know.
Thank you. So the next question has to do with the board process and procedures. What are those procedures that govern consideration and potential adoption of matters like the proposals that Vice Chair Barr is about to present to the board?
So on regulation, as opposed to supervision, on regulation, the Board of Governors votes on regulatory proposals, and it's a majority vote. We now have 6 voters, so when there is a proposal, it will be briefed carefully, and then we will have we'll have a meeting, or it can be done actually virtually, and probably will be that way, as most of our meetings are, and then we have a vote. On supervision, it's different. Most supervisory matters are really under the authority of the Vice Chair for Supervision under the law. So most of them don't have to go to the board for a vote.
So what percentage of the governors must vote in favor?
Majority.
The majority of them? Okay. Yeah. The California governor, prior to the depositor bailout for SVB, reportedly identified that he had been in touch with the highest levels of leadership at the White House and the Treasury. The governor also on Sunday, March 12, when the bailout was announced, issued his own statement praising that action. There have also been reports that the governor and his wife with respect to their business and perhaps other interests may have had depository interest in SVB. So when the Federal Reserve Board, the FDIC board, and Secretary Yellen, in consultation with the president, recommended invoking the systemic risk exception for SVB, and then decided to provide blanket insurance even on uninsured balances, did the Fed or any others, to your knowledge, perform any conflict of interest due diligence?
No. I mean, we were in an emergency situation on Monday morning. There was going to be, and there was a run on banks that looked. That
so looking back, do you think there was
we carried out our duties, and I'm actually pretty sure we did the right thing.
And you don't think there was any conflict of interest, even looking back?
I have nothing. I have absolutely no knowledge on that.
Okay. Well, thank you. Thanks for being here. I yield back the balance of my time.
Gentlelady yields back. The gentleman from Texas, Mr. Gonzalez, is recognized.
Thank you, Mr. Chairman and Ranking Member. Thank you, Chairman, for being here with us this morning. The June Federal Open Market Committee report indicates inflation in the U.S. and abroad continue to ease but remain elevated. In response to the FOMC, that has the proposed interest rate increases up until June 14th, recommendations to pause interest rate hikes for the first time this year, research has shown that the effects of monetary policy decisions, like raising interest rates, can take on average 42 months to be realized fully in the United States, meaning we may not fully understand the effects of this first increase in rates of March 2022 until next fall. With that in mind, how have our recent tightened monetary policies impacted the strength of the U.S. dollar and how it is valued globally?
Let me say that there's a lot of uncertainty around how long it takes monetary policy to affect real activity. There's no agreement on 42 months or any particular thing, and I think most people would say shorter than that. So you're asking how it would affect the dollar?
Yes.
So first of all, the Treasury Department has responsibility for the level of the dollar and the stewardship of the dollar as a currency. We don't actually comment on that. We don't look at any particular level. It's just another, to us, it's a financial condition. A stronger dollar means certain things, and a weaker dollar means certain other things. But
it continues to be a concern here in this committee. Also, Chairman, as you're aware, the Federal Reserve's core mission is to keep employment up and inflation down. Although I understand the calls for climate-related financial risk management from my colleagues, we should be focusing on the economic state of our country. The credit of the U.S. dollar is at jeopardy, and as you know, we've had global pressure recently, and we need to be sending a clear message that the world can rely on the full faith and credit of the United States dollar. We should be focusing on mitigating the calls to reduce dependency of the U.S. dollar. Monetary policy changes implemented in the U.S. are likely to cause a ripple effect throughout the global economy. With that said, would you agree that monetary policies to directly address climate change should be made by Congress and not the Federal Reserve, and implementing monetary policies and supervisory tools to exclude energy leaders from capital and financial institutions would have a grave impact on local, state, federal, and even global economies?
A strong agreement around the fact that we have quite a narrow role in climate change, and really the important decisions about climate change need to be made by elected people, not by the Fed.
Thank you, and I yield back.
Gentleman yields back. The gentleman from Florida, Mr. Donalds, is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Really appreciate you being here. Look, I got to say, first of all, it was good to hear from the other side of the aisle that the Federal Reserve should not even be engaging in using its tools with respect to climate change or climate mitigation or whatever the case might be. The Fed, you guys have a big enough job as is. Adding anything like that to your job, I think, will be wholly detrimental to the American economy. So I, for one, this morning am glad to hear that coming from the other side of the aisle. You've had a couple questions already on capital, bank capital, et cetera. Look, some of the current views are that continuous raises of bank capital will increase costs to our economy anywhere from $50 to $200 billion. What's your view of the current desire or mode of Vice Chair Barr to fully implement the Basel III capital standards?
Well, I think that's the next thing. Vice Chair Quarles was working on that. It didn't get completed for various reasons, but that, I think that's an international capital standard that we should go ahead and complete. As to the right level of capital, that's a discussion we're about to have.
Are you guys at the Fed? Are you guys kind of concerned about the fact that now it seems like the European regulators are starting to pull back from that? Like they're starting to think about capital standards being too much for European banks, and that they're starting to recede from what was, I assume, kind of a handshake agreement in years gone by.
Yeah, I'm not hearing that exactly. We'll be watching that carefully, though.
Okay. Overall, just with respect to capital, let's take a step back. Obviously, since 2008, 2009, we have, in my view, aggressively gone through this process of increasing capital standards and capital requirements on a Tier 1 capital for banks. In retrospect, do you think that's been a net positive to the overall banking environment, or do you believe it's been a negative to the overall banking environment?
So just to chime in there, guys, they're talking about the Basel regulations, which basically came after in the midst of the financial crisis as well, where you had to hold a certain amount of capital. So banks were able to get away with murder, really. They were rehypothecating money and lending it out everywhere. They wouldn't hold much money. So they was very susceptible to bank runs and even small movements in the markets and a bit of a bank run, and they were collapsing left, right, center. Now, what they did to mitigate that, they started introducing core ratios, core tier ratios. So each bank has to kind of adhere by these different ratios to keep a certain percentage in the bank on their balance sheet, such that if there was a run, they can fulfill. But they can't fulfill all of it. And that's the crazy thing. So we as crypto already hold ourselves to better standards, right? In that when we look at Tether, they are fully backed. When you look at USDC, they are fully backed, right? And many now stablecoins are over-collateralized, right? So let's not forget TradFi are miles behind.
So it's a focus for us. We understand the importance of community banks, that they provide a different service and a really important service to smaller businesses and communities. And community banks have been consolidating for 30 years now. So it's really a secular trend as people have moved to bigger cities and things like that. But we don't want to do anything to move that along. We think that the world's not a better place with fewer community banks, and we try to keep that in mind in all of the regulatory and supervisory things that we do.
Do you think that federal regulatory policy, in part from Congress, has led to a supercharging effect of diminished community banking in the United States?
It's probably been a factor, but I do think there have been important demographic factors as well. And also having interstate banking. Interstate banking only became legal quite recently, and that also has led to consolidation. You can look back, though, look back 30 plus years, and you've seen a very steady decline. So I think there are demographic and other factors driving it. But, regulation can fall as a fixed cost, which means that institutions need to be bigger. And I think that's probably part of the story.
Look, I don't disagree with your conclusion. I'm just concerned about the trajectory. I think just having larger financial institutions, larger banks overall with a diminishing smaller community bank infrastructure is detrimental to lending to small businesses, mom and pop businesses. It also could be parochial. I started my career in community banking, so I saw a heartfelt situation. Last question, running out of time. The SEC has proposed a rule that would, among other things, require banks to segregate client cash held in custody, upending custody bank balance sheets, and by extension, the bank custody model. Are you guys at the Fed concerned about this proposed rule from the SEC?
The gentleman's time has expired. The chairman can
I'll respond to that.
Writing.
Okay, fair enough. Thank you, Mr. Chairman.
The gentleman from New York, Mr. Torres, is now recognized.
Thank you, Mr. Chair, and thank you, Chairman Powell. As you know, the U.S. has foreign adversaries, particularly the CCP, that seem intent on de-dollarization. How seriously should the threat of de-dollarization be taken, in your view?
Well, the status of the United States, of the dollar as the world's reserve currency, is a very important thing to us. I think the reason we have that status is largely due to our great democratic institutions, the rule of law, and the fact that we have, generally speaking, had strong levels of price stability. And I think that the dollar will remain the reserve currency as long as those things are in place.
Well, I want to explore that answer because commentators often speak of the dollar as the world's reserve currency as the cause of America's economic dominance. Do you think of it as the cause of America's economic dominance or as a consequence of it?
To me, it's more of a consequence. And also, there tends to be an equilibrium where one currency becomes the accepted global standard, and that has been the dollar for some time, and I expect that it will be for some time, continue to be.
It's often said that the Fed has a dual mandate of maximum employment and price stability. Do you view these mandates as equally binding upon the Fed, or does one supersede the other?
They are perfectly equal under the law.
And I'm curious to know what it means in practice to have a 2% inflation target. The latest pause notwithstanding, does it mean the Federal Reserve will continue raising interest rates until the 2% target is reached, even if doing so comes at the expense of maximum employment as well as financial stability?
No, it doesn't mean that. It does not. So the way we think about it is most of the time the two goals are aligned in the sense that if you're achieving one, you're achieving the other, and if you're a little bit off the other one, they move in the same direction. Today's situation is unusual in that we are overachieving, in effect, the maximum employment goal, but we are far from achieving the inflation goal. So in our system, we have a constitutional document, and what it says is that when that's the case, you look at how far you are from the goal, and you look at the speed with which you would move back to the goal. And so that would tell you today that we should focus heavily on inflation, but as it becomes closer, as the two things become more aligned, then they go back into perfect equality under the law.
So the Fed engages in a delicate balancing act between employment and inflation.
Yes.
To what extent do you factor in financial stability, safety, and soundness when raising interest rates?
So you're right. We do have a financial stability mandate, but we try to.
Well, you have a financial stability mandate with respect to your role as a bank regulator. But when it comes to
also just generally, we're the lender of last resort. Central banks were originally created to support the financial system in times of stress and to make sure that you don't get into times of stress. So I would say that. Sorry, what was your question before that? It was
to what extent do you factor in safety and soundness when setting interest rates?
Sorry. So we really try hard to use our financial stability tools for financial stability purposes and our monetary policy tools for monetary purposes. The reality on the ground is much messier than that. They're very much entangled, and one affects the other. So the separation is not at all perfect. But we do think of these as separate things with separate tools.
Do you think that the Silicon Valley bank failure revealed a deeper tension between the safety and soundness mandate of the Fed as a bank regulator and the mandate of the Fed as a administrator of monetary policy?
I would say no, and I'll tell you why. Interest rate risk is one of the most basic banking risks. We supervise for it. Overwhelmingly, U.S. banks did manage their interest rate risk. Silicon Valley Bank didn't, and even though we were, the supervisors were pointing that out to them, they just didn't take, the bank didn't take action quickly enough. So I would have thought that you can say that it was interest rate hikes that caused portfolio losses, but it was management that failed to hedge against those losses and failed to hold appropriate liquidity.
In the pre-COVID world, we had the best of both worlds, low unemployment, low inflation for decades. Do you believe that we could return to that best of both worlds, or are high interest rates a new normal in the American economy?
So we will return to 2% inflation and maximum employment. What will be the level of interest rates there? That's a really good question. And
do you suspect it's going to settle at a higher level than we've known historically?
I think it's really hard to know. It's a great question. We talk about this a lot. The people who argue that they will move it back down just point to the fact that it was really global factors that drove rates down in the first place. Maybe the truth is somewhere in the middle.
Gentleman's time has expired. The gentleman from Nebraska, Mr. Flood, is recognized.
Thank you, Mr. Chairman. Chairman Powell. I'd like to discuss the continued efforts to unwind years and years of quantitative easing and what it's done to our Federal Reserve balance sheet. If you take a look at the size of the Federal Reserve's balance sheet, Since the 2008 financial crisis, we've seen an alarming increase from around 800 million to today's 8.3 trillion in assets. Back in 2018, you did start the work of winding down the balance sheet. You managed to offload roughly 700 billion assets between the beginning of your time as Federal Reserve Chair and August of 2019. The problem was, shortly after your efforts began, we had another major economic shock, the COVID-19 pandemic, that caused the Fed to once again return to quantitative easing as a form of economic relief. Pretty soon, the Federal Reserve's balance sheet had increased another $4 trillion in size. That's how we made it to the balance sheet level that we are at today. I understand you have started working to shed some of the Federal Reserve's balance sheet, and I appreciate the work. That being said, the scale involved here, to me, is startling. My concern, Chairman Powell, is that efforts to shed assets from the Fed's balance sheet have never been anywhere as quick as efforts to build it back up. Our economic cycle does go through recessions from time to time. It's not always boom, but some bust too. If we continue a pattern of rapidly building up the Federal Reserve's balance sheet in bad times and slowly shedding assets in good times, we're going to see the balance sheet grow significantly over time. Chairman Powell, is this a concern of yours? And to pair with that question, long term, how can we avoid an environment where any effort to unwind the Federal Reserve's balance sheet is undone anytime there's an economic shock?
It is a concern, and that's why we are this time the balance sheet roll off is much faster than it was back in the first episode. We also know more. We hadn't grown our balance sheet like that, and we hadn't shrunk it before. Now we have experience with that, so we are moving back down to a level that will be appropriate for our new framework. By the way, we won't go back to a framework where we were dealing with scarce reserves. We like the administrative rate framework that we're in now. But it is important that the balance sheet not just grow with every cycle, and I think I'm very conscious of that.
Chairman Powell, do you have an optimal Fed target for the size of what the balance sheet should look like? A number?
I'll give you the idea, and that is, you find the number, but the idea is that it's smaller than now. It's a place where reserves are abundant, and also have a little bit of a buffer on top of that, so that we don't accidentally run into reserve scarcity. Demand for reserves can be volatile, and you don't want to find yourself, as we did a few years back, suddenly finding that reserves were scarce, even though we didn't see it coming, and we then had to put more reserves into the system at a time when we didn't want to be doing that. So I think you want to have a level where we have ample reserves plus a buffer, and that'll be a % of GDP that we get down to, and we're moving in that direction pretty smartly.
Chairman Powell, realistically, how quickly can the Federal Reserve unwind its balance sheet? What's the threshold beyond which an asset sell-off by the Federal Reserve would disrupt our markets?
So we don't sell assets. What we do is we allow them to mature and passively roll off. And that's what we're doing, to the tune of about $1 trillion a year. And we're in the middle of that process. Now we will, it's an empirical question. You're going to find a level that is still ample, plus a bit of a buffer, and that's how we're thinking about it.
Thank you, Mr. Chairman. I would just reiterate my concern on this issue. I fear that having the Federal Reserve backstop so much of our economy through the holding of treasuries and mortgage-backed securities is not sustainable long-term. Thank you, Chairman. I yield back.
Gentleman yields. The gentleman from New York, Mr. Horsford, or Nevada, Mr. Horsford is recognized.
I thank the chair and the ranking member for holding this important hearing, and thank you, Chair Powell, for appearing before the committee today. Before I begin, I'd like to ask permission to enter into the record editorial by the Las Vegas Sun entitled "Economy Infrastructure Thrive When Dems Have the Reins," dated June 16, 2023.
Without objection.
During this time of increased economic uncertainty, it is more important than ever that the Federal Reserve fulfills its dual mission of maximizing employment and supporting price.
Bitcoin is going straight for 29.8 here. Look at it. It's just not stopping here the last 3 5-minute candles. It is off.
Specific. However, the human cost is simply too great for us to get this wrong. Sometimes we need to be reminded that there are real people behind the economic data, and that the actions taken by both Congress and the Fed have real consequences for everyday Americans. everyday Americans who want to know that myself and my colleagues are dedicated to creating an economy that actually works for them, which is why I was pleased that last week the Federal Reserve decided to pause your interest rate hikes and take stock of the overall economic picture. Now, don't get me wrong, there's certainly more work ahead of us, but with 13 million jobs added since President Biden took office, we should be rooting for America to succeed and not to fail. The strength of
Guys, forget that. Look at that. Look, skyrocketing there, 29.8, trying to go straight to 29.9. This is powerful.
And I believe our economy remains resilient thanks to the historic investments that were included in the legislation passed last Congress and signed into law by President Biden. These beneficiaries of these investments were the people, the middle class, not special interest. The bipartisan infrastructure law is creating construction jobs and projects that will help ease supply chain challenges and ensure safer transportation for everyone. President Biden and congressional Democrats are investing in technology that will define the 21st century, components to generate solar and wind energy, semiconductors and electric vehicles that will all be made here in America. Just last week, Treasury Secretary Yellen was before this committee and described how the transformational investments from the Inflation Reduction Act are ushering in a renaissance of domestic manufacturing. These are good-paying jobs, union jobs, that are expanding our production capacity here at home while reducing our reliance on goods imported from abroad. As I indicated in the editorial by my hometown newspaper, the Las Vegas Sun, remarks that annual investments in manufacturing construction has more than doubled its pre-pandemic levels. Furthermore, when we narrow the focus to the region, including Nevada, the U.S. Census Bureau estimates that in just 2 years, private manufacturing construction increased almost tenfold. So if we want to rebuild the American middle class, we must do so from the middle out and by investing in modern infrastructure and modern manufacturing facilities. But this does not mean that everything is improving equally. I've heard time and again from my constituents about the cost of housing being one of their biggest pain points. The Monetary Policy Report points out that housing services prices have risen a shocking 8.5% over the 12-month period ending in April, and in my district, it's even worse. So, Chair Powell, at a time where it has become increasingly difficult for working Nevadans to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a house provides. While higher rates have cooled some housing markets across the country, what do you see as the biggest remaining upward pressure on housing services, and what can we do in Congress to incentivize?
Nothing. You lot do nothing. You all fail. All you central bankers, even in these so-called first world countries, people are realizing if they don't take care of their financial freedom, nobody's going to hand it to them. You governments can't even ensure that people have a 2-bedroom house to live in. Right? You're killing them on mortgages, killing them on interest rates, killing them on the finance on their cars. They're taking it into their own hands. Why? They're investing in crypto. They're doing side hustles. They're learning themselves. And it's the right thing to do because you lot mess up time and time again.
So there's certainly a need for more housing. I think during the pandemic, you had people wanting to live in houses rather than downtown in apartments because of COVID. You had low rates, and so you had 2 or 3 years of very, very high price increases for housing, and now that is flattened out a lot as we've raised rates. And
Gentleman's time has expired. The gentleman from New York, Mr. Lawler.
Thank you, Mr. Chairman. Chairman Powell, you, the Fed's Vice Chairman for Supervision, and many others have indicated that the banking system is well capitalized. Bank capitalization remained robust during the COVID shock and related shutdowns of economic activity and in severe Fed stress testing. Nonetheless, the Vice Chair for Supervision wants to increase capital and other requirements on financial institutions. This will have substantial economic effects that will begin immediately while you are still focusing on bringing inflation back to the Fed's 2% target. Excessively high capital requirements will constrain credit provision to the economy, costing jobs, incomes, opportunities, and living standards. As my colleague Mr. Garbarino pointed out, a 1% increase in capital requirements could potentially reduce GDP by up to 16 basis points based on the Basel Committee literature. On January 21st, 2021, 30-year fixed-rate mortgages had an interest rate of 2.77%. Now, for the same loans, individuals are looking at a 6.69% interest rate for a 30-year fixed-rate mortgage. For the median home, valued at $436,800, the difference from less than 2.5 years ago to now equates to over $300,000 more over the course of the loan. For the median household making around $71,000 a year, that extra $10,000 a year out of pocket in mortgage costs is crushing. Some areas like my district are even harder hit due to the high cost of living and the lack of housing. Combine that with inflation at or above 4%, and these factors are taking a real toll on the average American family, including in the Hudson Valley. Now, further decreasing the availability of credit to households and businesses across the country would only likely worsen this crisis. So, Chairman, do you agree that excessively high capital levels constrain banks' lending capacity with spillover effects on jobs and living standards for Americans, and effects would begin immediately, independent of any proposed phase in timing?
I do think that, as I mentioned earlier, there is a trade-off between safety and soundness and availability of capital, and you want to get that balance right.
But respectfully, you have testified that there was more than enough capital in these banks. So where are we unsafe and unsound that we would require more capital requirements?
Well, as I mentioned, that's the question we're going to be asking as we review the proposals when they do come forward. We don't have a proposal in front of us at this point, and I think as I mentioned, any increase in the capital for the large banks would need to be justified. I don't know that there will be much in the way of capital increases proposed for banks other than the very large banks, but we'll have to see.
So you don't believe regional and community banks will face the same requirements?
Very different requirements, I would think, as they do now.
But you're not looking to increase the requirements on them?
We'll have to see what the proposals turn out to be. Honestly, they're still to some extent in motion, and once they're out, we can have lots of conversations about the specifics. But until they are, it's tough to do that.
And you'll commit to providing this committee with all such analysis before any proposals come out?
I think there will be a proposal that comes to the board.
Bitcoin looking really strong here, guys. Look at that. Look at that. 29.9. Expect there to be some resistance here. 30K is not an easy level. I'm surprised at how quickly it pushed through, obviously, 29,000. I mean, we started entering the 29,000 region here. You can see it faced a little bit of resistance, and then it just forced its way straight through. Now I expect the same. Like, we're going to probably face a little bit of resistance around our smiley face, which we drew at the start of the live stream. But the question is, are we going to get a harsh rejection from 30? Remember, it's not just 30, right? If we zoom out, remember, this is the pattern we're forming. This is the first point. We cleared it. Then this is the second point. We cleared it where we're doing it now, around 29.9. And then you've got the top level here, right? 31. So 30 and 31 are two separate resistance levels. Now, at the same time, you've got Phantom moving up a little bit here today, up 7.65%, coming back towards 30 cents. You got Ethereum back at 1853, Cardano moving to 28 cents, Matic up 5.89%. All coins are moving, to be fair. They are moving, but again, it's not my worry right now. My worry is let Bitcoin do the work. These altcoins have no choice. Like you're seeing right now, they have no choice but to follow once Bitcoin gets going. They have no choice. They will follow. That's how the money flows.
Meet and pay their bills.
I strongly agree with that, and that's why we are taking the measures we're taking.
Thank you.
Gentleman's time has expired. The gentleman from North Carolina, Mr. Nichols, recognized.
All right. Thanks, Chair Powell, for being here with us today. Back in 1995, I worked here in Congress as an intern for Dick Gephardt. I was in.
Just got a notification here. Veracity up 27%. Veracity 27% on the day. Render up 12%. Another big mover on the day. You've got Bobo, the meme coin, up 35%. Pepe back up. Remember, Pepe up 12% here, moving. Cadena 12% on the proof of work news. There's bullishness in this market, guys. There is bullishness in this market. We are seeing some double-digit moves here today, and this is the power of the crypto market. You get these massive candlesticks, these massive moments where if you're not in the market for a couple of days, like yesterday and today here on Bitcoin, if you were trying to do your little timing combo like other YouTube channels are telling you, you miss out on the move. You miss out on the move, and that's why you're better off holding through the pain, having conviction so you can benefit from these days. Otherwise, you're going to keep kicking yourself. You're not a master timer, even if you're the best technical analyst in the world. It's tough to do. From trading perspective, trade this. What a beautiful move here you traded, right? Hopefully you guys entered this trade with me, and that's a nice, beautiful trade. But for your long positions, that's 11% on spot. Loads of people saying you can't make money on spot. Of course you can. Taking it to the top of the price target, 15%, right? If this plays up towards our full price target of 37, then you're looking at a fully extended move here of 38% on spot, right? So you can trade while still having your long-term portfolio. That's how I do it.
The cost of groceries, rising inflation, interest rates going up. And when we do these hearings, it's always big news. The things you say, move markets and are very important. But Fed speak is just so hard for my constituents and the American people to understand. What can you tell the American people who are concerned about the economy in a way that they can really understand where this economy really is heading?
So I guess I would say this economy is very strong, and what's driving it now is just a very strong labor market. There's still significant demand for workers. There are more job openings than there are unemployed people. Wages are moving up, and that's really what's driving the economy forward. People's disposable incomes are coming up. Inflation is moving down gradually. The thing that troubles people, and I think the thing that accounts for the surveys you see where despite a historically strong labor market, people are still concerned about the economy, it's really inflation. So this is our job, is to bring inflation down. The way we do it is by raising interest rates. And while that can be painful, what it does is it gradually slows down demand so that supply and demand can get back into alignment, and so that we can have inflation running at 2% and people can get on with their lives and basically not have to think about inflation. That's what the definition of price stability from one standpoint is, just that people can live their daily lives without thinking about inflation all the time. We want to get back to that place, and we're on a journey to get there. We have quite a ways to go, but we're making progress.
And I've always wondered.
They pay off their debt, they take out unprecedented loans, drive up the debt on their balance sheet, and then erode it away by driving inflation at the cost of you and I. That's how the model works.
I wouldn't want to comment on that.
That's a safe answer. All right. And I do want to just join on the chorus with a lot of my colleagues on both sides of the aisle here about capital requirements for banks. I brought this issue up with Vice Chair Barr, with Mickey Bowman, and in your written questions for the last time you were here, I didn't get a chance to ask questions because my seniority here on the committee. But you said you answered in writing, and you said we've got to be mindful of the trade-offs associated with adjusting capital levels, as it could, quote unquote, cause banks to reduce the availability of credit or to pass higher costs of credit on to consumers, end quote. And you also said that, quote, capital and liquidity levels at our largest, most systemically important banks are at multi-decade highs, end quote. My constituents sent me here to lower costs for working families, so increasing borrowing costs really hits them hard. As the Fed considers new capital requirements, how do you intend to strike that balance between the trade-off that you talked about in your written response?
So that is the balance. You said it very well. So stronger capital requirements mean we have a stronger banking system, means it's more resilient to downturns and crises and things like that. So banks can continue to lend
$70 away,
even stressful times. And so that's
such a key
very
level.
important. And
let's leave Jerome Powell for a bit. I want to watch this price action. $50 away, guys. $50 away from 30K. 30K is a really important psychological level. Really, really important. It was the area we were around that 29, 30K level for summer of 2021. Look at that, pushing through now. $10 away. We're right there, knocking on the door now. Smiley faces waiting, which we had drawn a little while ago. Perfectly to trade, guys. If you want to trade with us, Ijaz.UK/Bybit. Get practicing with a little bit of lunch money. Learn how to trade. Once you learn, it's a superpower that stays with you for life. Anytime you need a little bit of money, you know how to trade, right? It's active income. Do I think it's going to make you a multi-billionaire and grow your wealth? No, but it can change your life, right? It can be enough to bring you in some money when you need to and trade, and then you can learn how to invest longer term. So you need a trading account, you need an investing account, but to get started, sign up, play around, learn the markets like we're doing here, watch the videos, I share chart patterns with you, be in the Telegram, And you too can benefit from this latest move. Look at this, just knocking on the door of 30,000 here on Bitcoin. Major level, given what the SEC were trying to do. It was a dark place when they did that. They hit Coinbase, they hit Binance, they tried their best, and Bitcoin remained resilient, and now biting back.
Core CPI is still over 4%, and services and housing costs remain very sticky. Given the economic uncertainty on how the Fed will bring inflation to its 2% mandate, can you quickly touch on how the bank capital requirements Vice Chair...
We're going to touch it any second now, guys. There you go. There you go. It touched 30. It touched 30 here on Coinbase Exchange here. That did wick past 30. Now the question is, can we claim 30? Can we hold 30? Or is it going to be a case of getting rejected? That's now the next level. We've got to get above it. I want to see us break above it. Retest it as support if we need to. But we don't want to get a hard, painful rejection. This is just a small 5-minute chart, guys. So don't overreact by this. We're going to see over the next hour or two, where do we retrace down to? You know, it's okay to retrace. Let's just zoom out here and kind of spend a few minutes, and I will jump over to Powell, I promise. But I just want to show you guys where we're at right now. So if you imagine here, let's just go to the horizontal chart. We're just touching that 30K level, right? We've got loads of horizontal structure, and the natural place for us to come back and retest here is 29,000 flat. If it wants to come back to 29,000 and retest, absolutely fine. If we zoom out to the 4 hourly, you see even clearer here, right? If over the next period of time it wants to come back down here and retrace, that's perfectly fine. Even coming down to this wick here, which is at 28.5, is not an issue really. If I bring out the EMA ribbon, you will see how extended we are from my EMA ribbon. It's almost ludicrous here, the move on Bitcoin. So for this to kind of come back down to these levels, 29, 28, like I just shared with you, and then this dotted line even here at 27.7, these are good horizontal supports. You've got the EMA ribbon, which comes in as support at 27.5. So there's a lot of room for Bitcoin to call off here if the RSI wants to reset. And if I was looking to add, those are the positions I would personally be adding. I would not be chasing these green candles. That is not what you want to be doing here on this price action. If you're not in on this move, wait for a calling off. This is very, very extended here on Bitcoin. That being said, now facing 30,000, which is of course very important resistance. You've got a bunch of resistance thereafter at 31, and breaking 31 will then give us the huge breakout of the cup and handle, which I'm most excited about, which is this big cup and handle pattern here, which we're forming. We're now broken out of the handle, heading towards the neckline here of the cup and handle. So that's the first phase done. Nice, beautiful trade. Let's see if we can keep it moving up towards the next levels here on Bitcoin.
Some years before it would go into effect. According to a report published last year by the Federal Reserve Bank of Cleveland, in the case of implementation Basel III, banks began to increase their capital ratios, and I quote, prior to the publication of specific language applicable to U.S. banks, end quote. And that bank responses we estimate to take place well before Basel III rules started to come into force after 2014. Do you agree with the Cleveland Fed, and do you believe that our banks will begin to adjust as soon as the proposal is released?
Yes, I do. It's not an absolute thing where they'll wait until the effective date. They will certainly, and they may even be starting, but I would think the earlier you start, the more gradual the path will be.
Very quickly, I want to turn to a different subject. It's been brought up by a number of my banks back home relating to a central bank digital currency or any federal issued coin. We have seen how this administration and the last Congress wanted to require anyone who made more than $600 on a third-party settlement organization like an eBay purchase has to report that to the IRS. The existing threshold before the law was modified was $20,000. That is how far this administration wants to peek behind the curtain of what my constituents are spending their money on. And $600 in Iowa doesn't go a long way. It's the equivalent of a PlayStation or paying for your kids' dance classes. I'm a dad of 6. I digress on this, but I do want to know specifically, for my constituents back home, the thoughts of creating a central bank digital currency that tracks individuals. If the Fed were to offer a direct individual accounts to citizens, wouldn't this be a direct threat to the financial privacy of many Americans?
Potentially, and that's why it's not something we support.
Guys, if you want Binance merch, make sure you sign up at ijaz.uk/Binance. I will be looking to see who signs up there, and I will be giving away hats, t-shirts, I've got hoodies, I've got the Cristiano Ronaldo NFT special t-shirts as well, which are all Binance merch. Make sure you sign up at ijaz.uk/Binance. If you have another account with Binance, set up another one with using my link, otherwise it doesn't count, and I'll be able to give this merch away to you guys.
Across the board. With that, I yield my time and recognize the gentlewoman from Colorado, Ms. Peterson, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us again today.
I come from Colorado. I was in the legislature for 10 years, and when the pandemic happened, I was part of being one of the, unfortunately, elected people during that time, that difficult time. When I think about what our country was going through a few years ago, where our economy was almost in free fall, completely shut down, our local governments were they were slashing their budgets, they were laying people off, and what that moment meant that we had to do in stepping up at the national level to infuse dollars to save our country's economy. So my frustration here is that we continue to talk about inflation as if it was spending just to spend money, instead of acknowledging the urgent crisis that this country and this world was in, and what we needed to do in the moment to make sure that we were able to recover, keep our small businesses afloat, our local governments, and ultimately recover much more quickly than others. So since we talk about this often, I'd like to know, if you look to other countries around the world who didn't infuse dollars like we did, is there countries that we can look at to compare what the outcomes would be, and what is their recovery like now?
Our recovery is by far the strongest of any country. And I would say inflation that we have is actually, everybody has very high inflation. The EU, the United Kingdom, many countries within Europe as well.
Thank you. That was my next question, is how we compare to other highly developed economies on our recovery. So it sounds like in the emergency that we were in, the hopefully once in a century global pandemic, that the United States ultimately met the moment, and that when the American people look at what has been done, we should feel really good about where we are, but we know we have a long ways to go. And so I also want to acknowledge that something that comes up often is that rising debt leads to increase in higher rates of inflation. Doesn't that also include tax cuts, trillions of dollars of tax cuts that we couldn't afford that went on our rising debt?
In terms of today's inflation? So I think if you look, to your point, you look around the world, there's a common factor that has driven inflation very high in lots of advanced economies, and it's the pandemic, and it's everything about the pandemic: the closing of the economy, the reopening of the economy, the fiscal support, the monetary support, all the things that happened went into high inflation. And inflation is coming down. We'll look back on this, and we'll be able to look back at a period of very high inflation. But I think it's not just monetary and fiscal policy; it's also just things to do with the pandemic, various shocks.
Absolutely. It's hard to believe where we were a few years ago and where we are now, although we do have challenges ahead. Another frustration that I have here is our failed policies around immigration reform and providing legal pathways for workers here in this country. When I talk to business leaders across the country, they say that the number one thing that we could do to address inflation is address legal pathways for people who want to work here. And so, while I recognize you say your job is to address inflation, you are still limited only within the tools that you have. So my question to you is, would an increased labor supply help supply chain issues and inflation in this country?
So we're seeing that now very much. A little bit to our surprise, we've seen a bounce back in labor force participation and also a significant return to the prior trend in immigration. And that, we believe, and most analysts would say that that's part of why employers are finding the labor market to be a little bit less tight now. It's still extremely tight, but that more labor supply is helping the labor market get back into balance, including through immigration.
Great, thank you. Another concern that I have is not just now our inability to address legal pathways to work in the United States and the consequences of not doing that to our economy. I really worry about in the long term if we don't address our labor shortage. So I'd like to know if we are unable to provide these pathways looking at the needs of this country, do you see this contributing to the rising costs and inflation here in the United States in the long term?
I'm not sure about the long term, but I would say that, right now still employers are reporting a very significant excess of demand for workers over the supply of workers. And so there's a lot of demand out there for people to work.
Thank you, Mr. Chair. Ladies, time has expired. I now recognize the gentlewoman from Texas, Ms. Dela Cruz, for 5 minutes.
I thank the chairman for holding this important hearing today. It is critical that this committee continue to explore how the Biden administration's ill-conceived policy and regulatory approaches are harming our nation's economy. And thank you, Chair Powell, for appearing before us today. I'd like to lead off with a question that I posed for Vice Chair Barr when he recently appeared before this committee. As representative for a largely rural district where my constituents, of which 86% are Hispanic, heavily rely on smaller institutions or community banking institutions for their financial needs, I am concerned about Mr. Barr's focus on factors that aren't necessarily material to the recent bank failures. His report on Silicon Valley Bank seemed to go out of its way to advocate for higher capital levels as a cure for the recent bank failures, instead of the failures of regulators and bank mismanagement. In fact, one of your other colleagues, Federal Reserve colleagues, Governor Bowman, echoed these concerns in recent remarks when she said the unique nature and business models of the banks that recently failed, in my view, do not justify imposing new overly complex regulatory and supervisory expectations on a broad range of banks. If we allow this to occur, we will end up with a system of significantly fewer banks serving significantly fewer customers. Those who will likely bear the burden of this new banking system are those at the lower end of the economic spectrum, both individuals and businesses. Just a couple moments ago, Rep. Donalds asked you a couple of questions, and your response was that you mentioned how important community banks are and that you are keeping them in mind with all that you do. As I speak with my local community and regional banks, they say that the increase in regulation and in capital requirements will really hurt them. With that being said, what I find as being an outsider in politics, new to the political arena, I find that people here in Washington, people who hold leadership positions, are often out of touch. And so I want to ask you, Chair Powell, do you personally bank with a community bank?
I have over time, not currently, but yeah, the last mortgage that my family and I had was you would like the story, I can tell you someday, but we had a very large bank which sort of failed at the last minute to come through with our mortgage, and we went to the local community bank, and they knew my family and they knew the house, and they were able to give us a mortgage without difficulty within a few days. So I have very positive experience with community banks.
So with your relationship with community banks in the past, how do you feel that increasing regulatory burdens would have consequences to these community banks?
So I really think that the things we're looking at are not about community banks. They're about the very largest banks, and to some extent, banks in the Silicon Valley Bank range is sort of $100 billion to $250 billion. So that's far larger than I would consider a community bank to be, under 50 and probably under 10 billion in assets. So those are not the focus of the regulatory reforms, I believe, that are going to be proposed to the board for consideration this summer.
And I will also hope that be true, because, as I said, in my district, we have a lot of community and regional banks that would suffer with increased regulation and capital requirements. And so with that, I have very little time, so I will yield back to the chair. Thank you.
The gentlelady yields back. I now recognize the gentleman from California, Mr. Sherman, for 5 minutes.
I want to comment on one success story. Several years ago, there were $16 trillion of LIBOR instruments where the amount the debtor was supposed to pay the creditor was to be determined by the London interbank rate. And as of June of this year, that rate will no longer be published. Something happened unusual here in Washington. A year and a half before the LIBOR hit.
This guy hates crypto, hates it.
Published your regulations in February, and the problem is solved. I want to pick up on the ranking member's comment that it's critical that we deal with housing. There's a lot we can do in Washington, but we also need to get cities to allow the construction of apartment buildings and condos. Someone has talked about the de-dollarization. We need to compete against the euro and against the yuan, but one place where Congress can act is with regard to crypto. The crypto billionaires have told us they want to displace the dollar. They're working for de-dollarization. And when billionaires tell you they are trying to hurt your country, you should believe them. There's been a discussion here as to whether it's the pandemic or Washington, D.C. policy that's caused the inflation. We have a perfect test case. Our annual inflation rate is now at 4%. The European Union, where Mr. Biden is not president and Mr. Powell is not head of their Federal Reserve, the European Union is in May had 7.1% inflation. The unemployment rate in the United States is 3.7%. The European Union is at 6%. And since the pandemic began, GDP has grown in the United States 5.3%. In the European Union, only 3.1%. I think it's pretty apparent that our policy has turned out to be actually better than Europe's policy. Banks and bank regulators have said, oh, how could we possibly have anticipated the inflation and interest rates of 2023? Today we have 4% inflation. That is almost exactly the average inflation rate over the last 50 years. Much lower than it was in the Reagan administration when we had 13.5% inflation, 16% interest rates. And that's why I blame the management and also the regulators at Silicon Valley Bank for telling us that, oh, this was an unanticipated circumstance. It's certainly one of the things they could have anticipated. I'll point out that both the Congressional Budget Office and the University of Pennsylvania Wharton School of Business's models both show that the estimated effect of the Inflation Reduction Act on inflation will be statistically indistinguishable from zero. So we'll accomplish a lot for the environment and not increase inflation. Of course, the recent action by Republicans to take away IRS enforcement will lead to higher deficits and higher inflation. The chair of the committee tells us we don't need regulation of our well-capitalized banks. Why are they well-capitalized? Because of our regulation. And I do want to focus on whether our banks really are well-capitalized. Mr. Powell, are our banks well-capitalized if you value their assets at today's fair market value, where we have experienced higher interest rates and the value of the debt declines? And are they well capitalized even if you assume that depositors are not just going to leave their money lying in the banks, but that the obligation the bank has to its depositors is valued at full face value, but the marketable securities and loan portfolio is priced at today's interest rates? Under those circumstances, do we have a well-capitalized banking system?
So I think you have to take the capital requirements as they are for purposes of this.
Well, that's the problem. Our capital requirements are hide the facts that are unpleasant.
Right.
If you don't hide the facts, are we well capitalized?
Traditionally, though, as you know, a rising rate environment has increased the value of the deposit franchise, which more than or at least offsets any portfolio loss.
So we're well capitalized if depositors are continue to be lazy and stupid.
The gentleman's time has expired. Chairman Powell can submit any additional response for the record. With that, we'd recognize the gentleman from Tennessee, Mr. Ogles.
Thank you, Mr. Chairman.
It's an interesting one, right? Because like in the crypto space, you wouldn't get away with it. You wouldn't blame the federal government for increasing interest rates. Ultimately, the banks held bonds, and those bonds went the wrong way because of interest rates, and their face value was very little. So when there was a run on the bank, they didn't have enough money, right? Now, the beauty about crypto is if you're a company like that, like Terra Luna or Celsius Voyager, you get found out. There's no way to hide to say, oh, look, Fed, bail us out, right? You're done. You're finished. It's survival of the fittest. And so that's one of the reasons these guys don't like it, is they don't have that control then. They like that TradFi they can control with the bailouts, because it means they can let the ones die which they don't care about, like Lehman Brothers, but then save others. It's not a meritocracy.
Now, going back to one of my colleagues' questions about the bank losses and the result of that being poor management and failing to hedge against the interest rate environment, is that a fair summation that management and failure to hedge is what caused some of the bank losses?
Certainly, many banks managed the interest rate risk that came along through that technique.
But some did not, is that correct?
Some did not.
In October, the Fed suspended its remittances to the Treasury due to losses. Mercatus Center estimates that the lost revenue for the Treasury will result in $760 billion over the next 10 years.
By the way, reminder, guys, any of you looking to learn TA, ijaz.uk/TA, the price of that course is only going to go up, guys. That course there is locked in. All future TA courses are going to be in there. Takes you from beginner to intermediate through to advanced. You're going to learn TA all in one place. It took me 10 years plus to learn in TradFi and in my own learning, self-taught as well on top of that. You're going to get it in one place. Structured curriculum, work through it, learn TA. You'll spot all these patterns. There is no way you go for all of that course and it doesn't make you a better trader. Impossible, right? So if you're serious about trading, if you thought about it for a while and just not being sure, work through the TA course, start practicing with some lunch money, and you'll see as you start to get more and more profitable, you'll naturally feel more confident putting more money into it, and then do it at your own risk. But definitely get started, ijaz.uk/TA. If you're not completely happy with it, then message me and let me know.
$2 trillion in profits to the Treasury Department because.
Oh, and also there is a pay monthly option as well for those of you who want to pay monthly. There is pay monthly installment options as well. No further cost. You just get to split the cost monthly.
In a way, that's what was happening during the QE era. As we now enter an era of raising rates, that'll turn around a little bit. But ultimately, though, we don't manage at all for fiscal reasons. What we're managing to is maximum employment and price stability, and we're using our tools to achieve that. So we don't think of ourselves as trying to attain some kind of fiscal goal one way or the other.
But what about as far as I guess I'll ask this question. When you look at, the roughly $700 billion in blow to the Treasury, how's that going to impact the President and Congress's kind of economic plans and policies going forward? I mean, is it going to impact negatively?
It's not. It doesn't affect spending, right? It doesn't affect. Congress appropriates money, the executive branch spends it. It affects it. So it will mean that more borrowing has to take place, and that could raise rates very marginally at the margin. But that's how it would affect the budget, but it wouldn't be a major effect on the budget.
Well, I didn't ask about the budget moreover than our overall economic goals. And I think what I think a lot of us are getting at is when you look at Main Street America, when you look at mortgage rates and how it's impacting, families' abilities to get a mortgage. And so someone who was eligible for $300,000 to buy a home now is no longer eligible for that home. You have people that are now upside down due to this, expansionary, interest rate environment. And I have concerns about, future raises and the impact that's going to have on small businesses, availability of credit, and again, your average homeowner. And the people that pay that or bear the burden of that are your lower income and your middle class families. Now, when you look at Silicon Valley Bank, which is supervised by the Fed, again, I get back to when you look at the interest rate increases why there was not more warning or hedging from you as the impact it may have on the fiscal system, the financial system, and the banking system, because as we well acknowledged, both sides of the aisle, that there was some poor management, but the regulators and the communication from the government was lacking. And Mr. Chairman, I am out of time. Mr. Powell, thank you for being here, and I'll yield back.
Thank you, Mr. Ogles. With that, the chair recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman, and I thank the ranking member. Welcome, Chairman Powell. Good to see you again. Chairman Powell, I heard some of your comments the last couple of days about the Fed seeking a softening in the labor market. And as a former union president for the iron workers,
all right, Fed Chair Jay Powell telling Congress it is appropriate to raise rates further and that inflation has moderated but still has a long way to go. Remarks very much in line with what the chairman said in his post-meeting presser about a week ago. Welcome, everybody, to the Halftime Report. I'm Scott Wapner. We're, of course, going to monitor the rest of that hearing and bring you any necessary highlights as they develop there down in D.C. In the meantime, stocks are trying to avoid a third straight day of losses this hour. The investment committee is with me to assess what all of this means to your money. Joining me for the hour today, Joe Terranova, Kerry Firestone, Jason Snipe, our senior economics reporter Steve Leisman is with us as well.
All right, guys, let's wrap that up there. We got what we wanted. Bitcoin is now sitting at 30K. Naturally, we will expect a retracement, right? Do not be surprised to see a little bit of retracement. It's healthy. It's normal. After an extended move like this, it's not bad to have a pullback. Do we want to pull back into these areas? You can see this first peak, which we beat around 28.2, can act as support. Then we got to get back to this level where we're at currently 30,000. Clear for it, hold for it, get some strength, break through 31. 31 is going to be the hard one, and then we're into our cup and handle pattern, right? Then things are looking really exciting. Now, of course, Jerome Powell is going to keep going. He can still rug the market. So if you guys do want to watch that, head over to CNBC and you guys can watch that over there. But in terms of this, make sure you go watch my video from earlier today where I explain all the key levels, all the key structures, how I'm trading it. If you guys want to trade with me, ijaz.uk/Bybit. Otherwise, thank you for joining me on another live stream. Really enjoyed it chilling with you guys. Thanks for watching. Make sure you hit up the like button if you're not subscribed.